Welcome to Iron Financial. I am your lead analyst, and our mission here is absolutely simple. We are going to help you forge a stronger, more resilient portfolio and cut straight through all this market weakness. Today, we are putting Deckers Outdoor Corporation under the microscope. We're going to tear into their fiscal year 2026 results to figure out if this company is genuinely built to last, or if it's eventually going to crumble under the extreme macroeconomic pressure we're seeing right now. And I'm the market skeptic. I am here to ask the hard questions on behalf of you, the audience. Because let's be completely real for a second. Deckers is the parent company of UGG and HOKA. At the end of the day, it's footwear. We are in an environment where consumer discretionary spending is facing massive, unprecedented headwinds. So we really have to ask, is all this momentum we're seeing just market hype? Or does this company actually have the structural integrity to survive serious, sustained market weakness?
Seriously, the macroeconomic landscape out there right now is incredibly hostile. We are talking about severe global geopolitical conflict, massive shipping disruptions happening over in the Middle East, rising global freight costs, and intense inflationary pressures at every step of the supply chain. Consumer credit card debt is sitting at record highs, and inflation is absolutely crushing everyday wallets. Consumers are supposed to be pulling back hard on discretionary spending, so how on earth did a footwear company navigate these massive supply chain cracks and this global chaos without completely collapsing? I want to know if their foundation is actually as solid as management claims, or if we're basically just looking at a house of cards waiting for a strong gust of wind. That is exactly what we are going to drill down into in this explainer. Because when you actually look at the raw materials of their balance sheet, they didn't just survive the chaos, they didn't just scrape by, they built an absolute fortress right in the middle of it.
Let's bring the hammer down immediately with the top-line number. For fiscal year 2026, Deckers forged a staggering $5.47 billion in total revenue. I really want to emphasize the sheer scale of that figure, $5.47 billion. That is an ironclad 10% increase over the prior year. They are not bleeding out, they are pouring a rock-solid foundation for massive future growth. Okay, a 10% top-line increase is definitely heavy lifting, I will give you that. But listen, a big revenue number doesn't always mean a fundamentally healthy company. A lot of retail brands right now are juicing their top line by deeply discounting their inventory. They are essentially sacrificing their margins just to move product off the shelves and keep the lights on. It's a survival tactic. I need to see what is actually driving this $5.47 billion before I'm convinced. Section 1. The dual-engine machine. Deckers is not reliant on a single, fragile pillar to hold up that $5.47 billion structure. Structurally, they've engineered what we are calling a dual-engine growth machine. Look at how this breaks down. We have HOKA generating $2.59 billion and UGG delivering $2.74 billion. The remaining $140 million comes from their other smaller brands like Teva. These are two distinct, massive, heavy-lifting forces working in tandem to pull the entire enterprise forward. Now that is genuinely surprising to me. I honestly assumed UGG would be carrying the vast majority of the weight here, but this is an almost perfectly even split between the two main brands. Exactly. It's a perfectly balanced distribution of weight. If you are constructing a resilient portfolio, this is the exact kind of load-bearing symmetry you want to see. Most parent companies have one cash cow and a bunch of dead weight, but here you have one engine providing raw, explosive growth and the other providing steady, reliable torque.
Section 2. The HOKA Growth Engine.
Let's inspect the first power source. HOKA is the explosive, high-growth challenger brand in their portfolio. This is the engine doing the aggressive expansion work, actively capturing massive market share in the highly competitive performance athletic footwear space. Right, HOKA. You literally see these thick-soled shoes everywhere right now. But my big question is this just a trendy fad that's going to burn out in a couple of years, or is it a sustainable structural shift in consumer behavior? The hard data proves this is absolutely no fad. This is a permanent structural shift in the market. HOKA's global revenues surged 16% this year. The global direct-to-consumer channel grew by 12%, and wholesale expanded by a massive 18%. Wait, hold on. Wholesale is up 18%? That means third-party retailers are aggressively demanding more product to put on their shelves just to meet foot traffic. Correct. Management explicitly noted that HOKA is capturing market share not just with hardcore marathon runners, but with everyday consumers looking for technical comfort. They are expanding into a massive total addressable market.
And here is the concrete proof that their brand equity is hardening. HOKA's brand awareness in the United States has surged from 50% up to 60%, and internationally it jumped from 30% to 40%. So let me get this straight. They still have 40% of the entire US market that doesn't even know the brand yet, and 60% internationally? That's a massive unpaved runway for future expansion. Precisely.
They are rapidly cementing their market position. They are planning to open 25 new HOKA stores annually, heavily targeting major international cities and pushing hard into China. China is a crucial structural pillar here because of its sheer volume potential. Capturing even a fraction of the performance running market in that region provides enough load-bearing demand to sustain this explosive growth rate for years to come.
Section 3. UGG's steady dominance.
Let's pivot over to the second engine in this machine. While HOKA is the explosive grower, UGG is supposed to be the reliable bedrock of the entire portfolio. But UGG is heavily seasonal. You buy them in the winter. If we have a remarkably warm winter, doesn't this entire bedrock just crack? How do they build a durable, year-round business on a winter boot? That is the old narrative, and the numbers absolutely shatter it. Total revenue for UGG was actually up 8% to $2.74 billion. Wholesale is up 13%. But the most crucial structural reinforcement here is that men's styles accounted for more than 20% of the brand's global growth in fiscal 26. Over 20%? So they aren't just selling to their traditional female demographic anymore? Exactly. Furthermore, their CFO noted they are driving a significantly bigger spring and summer business. By expanding across genders and seasons, they are actively breaking out of that seasonal trap. They are adding serious, year-round durability to their revenue stream, making that bedrock nearly crack-proof.
Section 4. Navigating supply chain headwinds. We cannot evaluate a company's true strength without testing it against extreme external pressure. Any company looks good when the sun is shining. Good, because this is where I see the biggest potential for total structural collapse. Look at the extreme pressure they are operating under right now. You have shipping disruptions in the Middle East adding severe delays. You have rising global freight costs just bleeding cash. Material upgrades are driving up input costs across the board. And worst of all, a staggering $120 million hit directly from tariffs. That is real, immediate structural damage to the bottom line. How on earth do they absorb a $120 million tariff bill without their margins collapsing entirely?
This is where the iron financial analysis really shines. Because despite an 80 basis point impact specifically from those tariffs, Deckers still delivered a massive 57.7% gross margin for the year. That's down only 20 basis points overall. How is that even mathematically possible? That math doesn't make sense unless they are somehow making up that massive loss somewhere else in the business. They are making it up through absolute ironclad operational discipline. Look at their inventory. Their inventory currently sits at $487 million, which is actually down 2%. They are not overproducing. In a retail environment where everyone else is panicking, slashing prices by 30 or 40% just to liquidate dead inventory, Deckers is keeping their supply incredibly tight. They don't have to discount their shoes, they are moving product at full retail price. That pricing power is what protects the margin, ultimately forging a best-in-class operating margin of 23.1%. That level of profitability is exceptionally rare in the footwear sector right now.
Okay, so the financial margins are tight, I'll give you that. But what about the operational foundation overseas? Because a cheap supply chain is very often a fragile one. If their overseas operations get hit with a forced labor scandal, the PR disaster alone is a major risk vector. That kind of thing could wipe out billions in shareholder value literally overnight. That is a critical point to audit, and it's something long-term investors must consider. Deckers addresses this structural risk directly in their fiscal 2026 statement against modern slavery. They are highly transparent about their supply chain risk assessment, stating they actively work to prevent forced labor and human trafficking within their global operations. And they don't just rely on their own internal checks to ensure stability. They utilize rigorous, independent third-party frameworks like WRAP, that's Worldwide Responsible Accredited Production, and SMETA to ensure their facilities adhere to fair labor standards. So they are actually letting independent auditors test the structural integrity and the real labor conditions of their factories. Yes. And they invest in concrete operational ethics, partnering with programs like Vision Spring, which physically provides eyeglasses to factory workers, increasing safety and well-being. A supported, healthy workforce is a stable workforce, and that prevents supply chain collapse right at the source.
Section 5. The power of DTC.
We need to clarify some terminology here. You mentioned DTC earlier when we were talking about HOKA growing 12%. I know it stands for direct-to-consumer, but why is this specific channel so absolutely critical to the structural strength of the business? Think of it exactly like real estate. Selling wholesale to a big department store is like renting out a room. You have to split the profit with the landlord. But DTC is a sales channel where Deckers sells directly to the end user through their own physical stores or their digital websites. It bypasses those third-party retailers completely. So by cutting out the middleman, they capture the full margin on every single pair of shoes sold. Exactly. It's like owning the building instead of just renting it.
It maximizes their control over the entire brand experience, it gives them direct, unfiltered data on their consumers, and most importantly, it dramatically fortifies their profitability profile.
Section 6. Capital allocation and the balance sheet.
This is the absolute make-or-break moment for me. Talk is cheap. Literally any CEO can get on a quarterly earnings call and claim their business foundation is strong. I want to see what they are actually doing with the cash they generate. Are they hoarding it out of fear? Are they wasting it on bad acquisitions? Or are they actually returning it to the owners? Oh, they are deploying it aggressively. Deckers executed $1.1 billion in share repurchases in fiscal 26 alone. $1.1 billion? Okay, that is a massive display of confidence from management. They are basically saying to the market, we think our stock is fundamentally undervalued, so we are just going to buy it ourselves. Exactly. And because they retired those shares, taking them completely out of circulation, their diluted earnings per share surged 11% to $7.02. And here is the true, undeniable flex of their financial strength. Even after spending $1.1 billion on buybacks, they still ended the year with $1.9 billion in cash and equivalents. That is the literal definition of a fortress balance sheet.
Section 7. The road to fiscal year 27.
With a foundation that strong, we have to look ahead at the financial blueprint for FY27. I am always extremely cautious with forward guidance. Companies love to overpromise and then severely underdeliver. They are targeting $5.86 to $5.91 billion in total revenue, but I need you to look at that gross margin target. 56.5%. They just delivered 57.7% this year. Forecasting a drop down to 56.5% looks like a visible structural crack in the foundation to me. Are the costs finally catching up to them? It is not a crack, it is a highly reinforced, extremely realistic forecast. Management is explicitly modeling in the continued heavy lifting required to absorb those ongoing freight costs. Most importantly, that 56.5% target assumes the current 10% tariff rate remains in effect for the entire year without a single refund. They are baking the absolute worst-case scenario right into the baseline. They are stress testing their own guidance to ensure they can confidently deliver it no matter what the macro environment throws at them.
And they aren't just looking 1 year out either. Deckers provided a multi-year, long-term framework spanning FY28 to FY30. They are officially targeting low double-digit earnings per share growth on a compounded annual basis. That requires serious sustained momentum. How do they practically guarantee double-digit EPS growth if top-line revenue might naturally start to slow down as they scale into a larger company? By continuing to return massive amounts of capital. Their outlook explicitly includes a plan to repurchase at least 80% of their free cash flow via buybacks. Let's translate what 80% of free cash flow actually means for you as an individual investor. If a company takes 80 cents of every free dollar it generates and uses it to retire shares, it is systematically shrinking the supply of equity. You own a larger and larger percentage of the building every single year without lifting a finger. It forces the value of the remaining shares to compound like iron.
Section 8. The verdict.
We've analyzed the raw materials, we've aggressively stress-tested the foundation, and we've reviewed the forward blueprint. This is what the audience is waiting for. We've seen the impressive top-line growth, but we've also seen the massive tariff hits and the supply chain complexities. We need the final summary right now. Is Deckers an opportunity to build real wealth, or is it a value trap just waiting to collapse? The verdict is completely clear. Deckers is an ironclad opportunity. This isn't a company surviving on temporary hype. It is a meticulously engineered, highly disciplined growth machine. They have a dual-engine brand portfolio in UGG and HOKA driving massive global scale. Through ruthless inventory discipline and full-price selling, they forged an unprecedented 23.1% operating margin despite facing severe supply chain pressure. And they back it all up with a true fortress balance sheet, holding $1.9 billion in cash, allowing them to aggressively buy back stock. They have absolutely proven their structural resilience.
Well, I really can't argue with the math. The foundation is incredibly solid right now. But as we sign off, I'll leave you all with this slightly more ominous thought to ponder. The market never stands still, and the pressure only increases as you scale larger. Can Deckers maintain this aggressive, high-wire act of growth into the next decade, or will escalating global tariffs and permanent supply chain headwinds eventually crack the armor? That is what we will be watching closely. Thank you for joining us on Iron Financial. Keep forging ahead, and we'll see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.